Tom Finke, Chairman and CEO of Babson Capital Management. Nice to see you in LA.
Nice to see you, Rhonda.
You actually were moderating a panel earlier that had to do with kind of the state of affairs, I guess you could say, about asset management, investing, what do investors do? And it's still a very tough environment for people. It seems that the recovery in one's portfolio has been long in coming. Is it going to change anytime soon?
I don't think anything's going to change. We're caught in a state, if you will, of low to no growth in global markets or slowing growth in emerging markets. Clearly the rate environment, post-crisis, people thought it was a few years and then rates will go up, inflation will produce, and here we are almost a decade later, and there's no sign that global rates are going to go up. If anything, we're testing the monetary policy theory of things like negative rates. And so for investors, that's difficult. You need yield in risk assets, and when there's such low rates, those yields are much less than what you're used to.
So many investors have looked at alternatives. That's been a growth area. What types of alternatives do you find investors are gravitating toward now?
I think some of the interesting themes are as you look at the public markets, and with yields low in corporate bond markets, for instance, it's forcing investors to look at alternative markets such as private credit, real assets, and certainly it's driving a lot of interest in real estate, even not just real estate equity, but into the debt side of real estate where there might be some more yield relative to corporate yields.
And within real estate, is that commercial real estate or is it across the spectrum?
Mostly commercial real estate. Certainly in the U.S., I think there's a lot of issues still with the U.S. mortgage market, and with really that's in the bank and the agency market. But in commercial real estate, as CMBS retrenched after the crisis, normal balance sheet lenders like insurance companies and some pensions came back, and now more are looking. We're starting to see a lot of international investors want to invest in, for instance, in U.S. commercial mortgage loans.
Since you mentioned that last crisis, let me ask you, do you think that enough steps have been taken to protect investors from the next crisis?
You know what, that's really hard to say. I think a lot of steps have been taken which are trying to prevent what happened before from happening, but there's a lot of different dynamics out there that could be the next crisis. And I think it's less about financial engineering or less about aggressive risk-taking by banks. And it's more about the things we don't know about, the rise of cybersecurity issues. Really, the flow of money post-crisis globally has increased. So you have new buyers coming into markets, and that in itself, when there's an excess of capital going into a new market, can create a bubble. It's hard to play forward, though, something the magnitude of the U.S. mortgage market collapsing. And hopefully we're not going to see something of that magnitude for a long, long time.
And of course, we never know where the next crisis is coming from, which is what makes it so hard. I want to ask you as well about liquidity, especially in alternatives. Do you see any liquidity strains in the markets right now?
Well, a lot of people feel there's a liquidity strain in public bond markets, for instance. And that somewhat reflects the changing of the guard where the banks and if you will, the market makers provided a higher level of liquidity pre-crisis to post-crisis. The reality is there's more investors who are called real money buyers that are there when markets dip to come into it. Now in alternatives, the investors are saying, I haven't gone there in the past because I viewed them as illiquid, I can't get in and out. But a lot of institutional investors are balancing the need for liquidity with the opportunity to get longer term cash flows and duration through alternatives, such as real estate or even in areas like real assets.
And in terms of real estate, what are returns that investors could expect over the next 5 years with real estate alone?
It really depends where you are. If you're just looking at high quality mortgage, they're lower yields. They're 4-5%. If you're looking at really real estate income properties, again, it depends. Could it be a higher single digit on core or value added properties? Yes. Could it be a little bit more if you're looking at development? Sure. But then again, that has its own risk the further out you go on the risk spectrum.
Tom Finke, it's been great chatting with you.
I enjoyed it. Thank you for having me.